Well, folks, I'll be damned. Today is not one of the best days. In fact, we've already had a little bit of a double-double of this in the course member live stream. So if you want some entertainment, you can always check out the programs on Building Your Wealth, link down below, where we have phenomenal and insightful discussions every single day, no matter what the hell is going on. Today, obviously, is a bad day, though, for many reasons. First of all, the QQQ is popping off of the 0% Fibonacci. Second of all, Tesla is crashing. And third of all, two core individuals who are helping me with my Series A launch that's coming up decided to go get a different job right before our launch. Probably one of the most disrespectful times you could possibly leave a company, but oh well, I'll handle it myself and with the other employees that I have. No problem. Plenty of, fortunately, course members have also reached out offering to come and help, and so we're going to have a great opportunity getting everything back and rolling. So if you are waiting for that Series A information, we're still probably 45 days or so out from more information, but you could always drop your email in at metkevin.com/Series A, and you'll be informed of all of the news there once it's ready. Now, QQQ, this is the 0% Fibonacci line. This is quite unexpected. At the same time as we had a few bits of news this morning, we had inflation expectations by consumers come out less than expected. 1 year inflation expectations for consumers came in at 7.5. We were expecting 7.8. Those are still very, very high numbers, don't get me wrong, but they came in lower than expected. This is a sign that what the Federal Reserve is doing is working. The yield curve, the 10-2 yield curve is steepening. We are at a spread of 21.67 basis points. This is a sign that what the Fed is doing is working. The 5-year break-evens, this is the market's expectations for inflation, have fallen. They're at 3.26. They're actually slightly lower this morning, about 3.24. But anyway, on the day, they're still down. These are actually very, very good things. In addition to this, the consumer continues to spend money, ridiculous amounts of money. And that is actually why we are seeing a hawkish Fed, because the consumer continues to spend money. We saw fewer packaged goods being purchased via UPS, although at higher prices. But we did learn that, for example, from JetBlue, we expect demand to be substantially higher this summer than even in 2019. And other companies, as we've been reporting over the last couple of weeks, are all indicating that consumers are still spending money like crazy. Great. However, the stock market doesn't care, because the stock market is pricing in recessionary fears and fears of greater rate increases. Unfortunately, that is also hitting Tesla, which we're going to talk specifically about Tesla and what's going on with Tesla. I guess this would be, though, an opportunity to just quickly mention that if you want to get into the real estate market and build some wealth with real estate, when and if real estate prices fall, make sure to build your credit using the Extra debit card. Go to metkevin.com/extra to learn more about the Extra debit card, where you could link your existing bank account. And when you link your existing bank account, you don't have to make a new bank account. You can simply make transactions as you would on a normal debit or credit card, but you don't actually have a credit card. They spot you the money over the business evening, and the next day they reimburse themselves from your account. It's like using a debit card, right? You're spending the money that you have. And then these balances paid can be reported to credit bureaus. Genius method of building credit. I think it's phenomenal. Regarding the Fed rate monitor, we're sitting at a 97% chance of a 50 basis point hike in the next meeting. That'll bring us to 0.75. We are sitting 0.75 to 1. We are sitting at about a 97% probability of a 25 basis point hike in June. And another 97% probability of a 25 basis point in July. Another 25 basis point at 97 in September. Another 25 basis points at 92% for November, with the possibility of actually 7% not raising rates in that segment. But then the 80% chance of being at 2% by December to 2.25%. And then there is, even though the expectation that the Fed's going to get to about 2.5 by the end of the year, which the market has not yet priced in the second 50 basis point hike. So I think that's probably some of the pressure that we're seeing right now. But we're also seeing substantial pressure on Tesla. One of the reasons we're seeing the substantial pressure on Tesla has to do with, obviously, Elon Musk winning the Twitter bid. And the reason for this is Elon Musk has raised money for Twitter in a few different ways. Elon Musk has raised $13 billion in debt from Morgan Stanley and others. He has raised $21 billion in equity financing. This is expected to be shareholder partners. And remember, this deal is probably not likely to close for a few months, so Elon probably has time to get that $21 billion in equity financing together. This would be like, hey, we got 2,000 shareholders, everybody throw in $10 million, and boom, we got our $20 billion that we need, roughly, probably closer to $10.5 million each person. And then you've got about $12.5 billion in loans against Tesla stock. And there is the concern that if Tesla stock falls, that Elon Musk could get margin called on this because he's pledging about $100 billion in Tesla shares as collateral. And we don't know exactly what the margin requirements are on this. And this is now leading to this speculation that Elon is either going to sell or dump Tesla shares or margin against those Tesla shares for the benefit of his Twitter acquisition, or possibly even that this Twitter acquisition will just distract from Elon Musk because he's got the boring company SpaceX, Tesla, now Twitter, and this individuals seem to think that this is too much for Elon to handle. I think people forget that when you're a founder-led company, your goal is to direct other individuals and employees and be a visionary, not to be the day-to-day manager. But anyway, in addition to this, we had a very disgusting opinion piece in Bloomberg this morning. And basically, the Bloomberg article complained that Tesla receives 90% of their revenues come from making cars. Geez, imagine that, a car maker getting 90% of their revenues from making cars. And because their revenue is not very diversified, they're vulnerable to the kind of market effect that hit Netflix and Facebook and that and even Nvidia. And that even though Nvidia is already down 40%, Tesla's only down 20%, and so it may fall more. And so after the publishing of this, in addition to Tesla being potentially vulnerable because of the Twitter deal, maybe having to sell shares, Tesla was now shoved down 11% on the day. Tesla was flat this morning before this article posted. And then, of course, we have the SEC filings regarding the 21 bill and so on, but we've already covered that. So, that is something that's going to weigh on the NASDAQ, which then becomes self-fulfilling, and then you see the NASDAQ sell off more. And so what do we have? We have the NASDAQ bouncing off the zero. Listen, I made a trade in January. I am well profitable on that trade, probably up $3 to $4 million on that trade. And I avoided substantial other losses on that trade. I'm very happy with the trade I made in January. However, this has led a lot of people to believe that I am now a trader. That's what I do, is I just cycle my portfolio in and out. This is wrong. I believe this market is still strong. I believe the consumer is still strong, and I'm not betting against America. I'm not betting against Tesla. I'm not betting against Tesla, Trade Desk, Google, whatever. I'm in this market. And so I bought more shares this morning. I'm not running away. Just like I don't run away from the person who's set me up with more than six-figure salary, paid vacations, paid trips, paid entertainment, and everything, and only asks for hard work in return, only to get rug pulled before launching a new company. That's pretty disgusting. Unforgivable, as we like to say. Then some people like to say, hey, but Kevin, you point the finger, point back at yourself. Fine. Maybe I demand people work hard, but I pay well for that. And so if somebody can't work a hard 20 hours, hard 40 hours, right? 40-hour work weeks, because instead they want to work a lazy 20, then you don't belong here anyway.